Welcome to David and David on Real Estate. Join us as we explore the ins and outs of
Good morning and welcome to podcast number 22. And today we have a very special guest. We have Eli with us. And I think David is going to do the introduction. Good morning, everybody.
Good morning, and it's Elan Weintraub, and we're so happy to have him on here. He's been working with our firm for a long time. He's very tight with my partner Jonathan Hacohen. I think they go back how many years, Elan?
Elementary school.
Yeah, so that's at least 3 or 4 years ago, right?
Pretty much.
It's been a while, but we want really excited to have Elan on here with us. He knows the mortgage business as much as anybody I've ever met. He does these type of seminars, webinars, podcasts. He's a regular. He's used to speaking about these things that he understands. He's known for his straight talk, no nonsense approach. That's the way he advertises himself. And he's a co-founder and director at Mortgage Outlet. So we're going to let Elan explain a little more about Mortgage Outlet, and as our conversation goes, and tell us a little about yourself. But let me just tell you from David Gorski, David Korman, we are so honored to have you on with us today. And once again, we're raising the bar to our podcast by having someone like you on here.
Well, thank you. Well, thank you. Thanks for having me. So I'm Elan Weintraub. I'm one of the two co-founders of Mortgage Outlet, along with my partner, Sean Stillman. We were just talking before we started recording. Sean is a high school friend of mine. Jonathan Hacohen is an elementary school friend of mine. So it speaks to the importance of loyalty and relationships, definitely. I actually just posted on my Facebook and LinkedIn about 30 minutes ago that we hit a pretty cool milestone at Mortgage Outlet. We just onboarded our 150th mortgage agent or broker. So we have 150 licensed agents and brokers. We do over $1 billion a year in volume. We're featured in the Globe and Mail, the National Post, CTV News. I speak at the Toronto Real Estate Board, countless real estate brokerages. And we are hardcore mortgage brokers. So we're all in. We love what we do. It's a very challenging industry. I tell people, mortgage brokering looks very, very simple. And it's like, what's your lowest rate? What's your lowest rate? And we'll talk about that. But I actually think it's a very complicated industry with all the regulations, all the compliance requirements, and it's a very technical field. And I liken it to being an architect or an actuary or a CPA or a lawyer or a realtor, where it is, a very technical thing that you need to invest a lot of time in. And I'm very, very pleased to be here. So thank you.
Well, we've got all kinds of questions for you. Just you discussing that, like the ding, 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 ding. Look, there's so many things I want to ask you first, but we can't ask everything first. But I think before we get into all that, I think David, give us a little bit of a market update, and we can get Elan to comment on that as well.
I'll sip my coffee while he's updating.
Oh my God, yeah.
Me too. That's why we throw it to somebody else, and so we get a chance to drink our coffee.
There you go. All right, guys, let's jump into it. So it is Christmas time, and things are slowing down just a little bit, and the numbers are pointing towards that. So when we look at number of offers being presented out there, we're down 9% for the same time last year. When we look at number of showings, we're down about 24%. When we look at number of sold listings, we're actually up 12% from the same time last year, which is a good sign. The days on the market are climbing upwards. So again, it just points to the market just cooling off all that slightly. And when I say, slowing down, I mean, we're seeing marginal decreases in activity, right? And I mean, it's pretty normal this time of year around Christmas. But the average days on the market is edging up 16% to 22 in Mississauga. And the average price is down 2% over the same time period. New listings up 7%. So when we look at these numbers, love the fact that listings are going up slightly. I love the fact that the number of properties sold is up 12%. And we are seeing the numbers of offers drop a little bit, 9% less offers being presented out there. Showings are going down, and again, pretty normal this type of year. But the one indicator that I like is that there's still listings going up on the market. We have a huge shortage of inventory. So it's really important that we see more listings come on the market. And I know,
Elan, is that similar to what you're seeing out there, or what type of activity are you finding these days?
Yeah, I mean, I think, you know, shortage of listings is definitely the theme. You know, for me, COVID, it's actually a really tough spot for mortgage brokers, but more importantly, realtors to assess, because, you know, working with a lot of realtors and clients all day, or, you know, especially throughout the pandemic, it's almost like things are changing week by week, and it's very volatile, and like the market is just like taking a breath and then getting hotter, and then taking a breath and getting hotter. Now we're going into Christmas, but Christmas, people aren't going on vacation, so they're in town. So like there's all these dynamics. It's actually a very difficult market. It's not like linear where it's like predictable. So it is a tough market, but yeah, definitely agree with shortage of listings. You know, my thought on the market, if I look sort of holistically and then get a little bit more granular, you know, shortage of listings, interest rates are at record lows. You know, people want real estate. You know, immigration isn't back, but it will come back eventually. So that will further fuel the market. So there's definitely a lot of demand for good real estate. Now, the one tactical thing that I would bring up is, you know, and I'm sure we're going to talk about this, there's a lot of talk about inflation. There's a lot of talk about rising interest rates. So there is a segment of buyers right now that maybe they got a pre-approval or a rate hold at, let's say, 1.99%. And that rate is expiring in, you know, 84 days. Those people are feeling pressure, because today, right now, a lot of fixed rates are, you know, 2.59, 2.69 and above. So if you've got 1.99, to a certain extent, that's a winning lottery ticket. And literally every day that lottery ticket is expiring. So there's this small segment of people that are really kind of extremely motivated to buy now. Now, again, I know we'll talk about this. I'm not a huge fan of fixed rates. I think it depends on the context, but definitely aside from shortage of inventory and all these wonderful things, there's that segment of people that want to cash in on their rate hold.
Yep.
Well, interesting that you mentioned that, Elan. So I had this exact conversation with a young couple like this past week, bought their very first home, but the seller needed a closing in April. Seller was going to be away for some of the winter.
Yeah. Oh, yeah.
Has a window to close, and they needed a long closing. And originally the buyers didn't care so much, but then they realized.
And they spoke with their mortgage broker.
Yeah, our mortgage is running out, and we got to close by the end of January. And I talked to them and I said, you know, did you do the math? Like, did you figure out exactly what the difference would be over the 5 years that you were going to get this mortgage? And they said, it's going to cost us about $50,000.
Substantial.
So they're saying, how do we close this at the end of January? You know, well, the seller doesn't want to move it. You know, can we close earlier and then rent it back to the seller, or make an occupancy arrangement with the seller, or do something? And we're still in the middle of that, trying to figure out a strategy to do it, because it's not insignificant dollars, right?
Oh, it's huge. And I'll make a comment, and I did say this about mortgages being technical. Depending on the lender and the context of the mortgage, a sale leaseback might not work, because now it's a rental property. And if it was structured as so there's, I mean, you know, you deal with this every day, but these are these like micro details that you wouldn't think about. And you're like, cool, we're closing January 15th. We're going to do a lease. Everybody's happy. And then again, it's like, no, that's not going to work either.
Yeah. There's other issues too. If you close and let her stay, you know, as a tenant, you know, it could potentially create landlord-tenant issues.
Oh, yeah, that's.
Or you try and structure it, it's an occupancy, not a tenancy. So maybe that's good, but then there's potential insurance issues. What if she trashes the place? What if something goes wrong? You got to maintain it for 2 months
100%.
while she's living there. Like there's a lot of problems with it. Not easy solutions.
Yeah.
So it's kind of funny, but just externally, you know, when you think of real estate, in my mind, it's easier to do a buy and sell versus a lease, because a buy and sell is like, here's your money, here's the keys. But a lease is like, what if the toilet doesn't flush? And what if I slip on the snow? So like, you're starting to get into this massive relationship that, again, creates a whole other, set of issues and problems.
Right. And you're doing this with a young couple who's never owned real estate.
Yeah, I mean,
they're not in the business of being a landlord and tenant.
No.
You could ask a bunch of people that, David deals a lot of times with, investment properties and people that are in the business of renting out, their real estate, the residential real, and you know how hard it is to get to deal with a tenant with any of these issues. So someone's going to do it for 6 weeks or 2 months. Like, it's a nightmare waiting to happen, right?
Yeah, absolutely.
And then you deal with buyer remorse as well. I mean, you move into a house and there's something you don't like about it. You're having completely different conversations about, not going through with the sale. And, you found out that toilet is making a lot of noise when you flush it. And, you somehow don't want to close the sale afterwards, right? So, I mean, you're dealing with a completely different dynamic, and it's really hard to go down that path.
So let's get into some of the things that the questions that I know David and I both have for you. And I want to start with one basic one.
Sure.
That someone that needs to finance, they're buying a piece of real estate. Let's be talking residential for the most part here. So they need to get a loan, and somebody says, I'm going to go to the bank. I'm going to go talk to one of the big banks and see what I can do and give them information and shop it around between these banks. So why are they better off coming to a mortgage broker versus just trying to do that themselves?
This is my favorite question. This is like
we start with a softball here.
Well, that's fine. I mean, I'm all in. So, I mean, I use a lot of analogies to kind of illustrate my points, but I have a very simple analogy here. Imagine you walk into a BMW dealership and you want a car. And you buy a car and you're going to get a good car. You're going to get like a reasonably fair price, and you're going to walk out and like, you're okay, like fine, right? But that BMW dealer is not going to tell you that Audi is on sale this week. They're not going to tell you that Tesla is, government incentives and electric and all this. They're not going to tell you, they're not going to learn about you and say, you know what, David, you drive carpool with 5 kids every day. You should buy a minivan, because BMW doesn't sell minivans. So the very simple answer is, and again, in a year or two, that BMW dealer is not going to call you and say, by the way, Audi is on sale now and you should switch to Audi, because they're only going to offer you BMW. They're also, and again, this is maybe yes, maybe no, they're not going to advertise that BMW just had a massive safety recall. If you ask them, they might bring it up, but they might not proactively. Where, my role, as a business owner, frankly, I want, and this is a very important part of how I work. The first 70% of what I do is to flawlessly understand my client. Who they are they married, divorced, are their kids young? I want to know everything, so that I don't help you buy a Ferrari and then 2 days later you come back to me and say, Elan, I have carpool. What am I doing here? And the more I understand you and I anticipate your needs in the future, the better I will match you up. So the first answer is just like, again, I don't care which lender you choose. And we have big banks like Scotia and TD. We have credit unions, like Meridian, Duke, Alterna. We have insurance companies like Manulife and Desjardins, alternative lenders. Like, we have the whole suite. I just want you to make an informed decision. And if you get your Ferrari and you have carpool, but we talked about it, that's still your decision. So my role is to help you understand all the options, all the advantages and disadvantages. And your role is to say, cool, I want this one. And, you don't have to agree with me, but at least you know what you're getting going in. And again, I just went through this, in the last few months, but I was calling up clients for a year or two ago. And I'm like, hey, I'm always monitoring your rates. You're with this lender. By the way, I can switch you to this lender, save you money, lower your rate, But like, your bank is not going to do that. Your bank is not going to call you and tell you to switch banks. So
that's a great analogy.
Thank you. I got a lot of them. Your head is going to explode. Thank you.
It's funny. My dad he used to be in the menswear business, and every time he was going to do an analogy, talking to somebody, whether they should buy a suit or this or that or a coat, he always went to cars all the time too. Somehow people understand.
Well, people
cars.
listen.
When we talk about the level
yeah.
of service and the differences,
Right.
you go into in those days he wasn't talking Ferraris and BMW. It was more, the Cadillac was the king of the hill.
Right.
But it's always, everybody understands a car analogy. So I thought that was brilliant.
Yeah, and I mean, even I'll say, again, we work with a lot of lenders. Some of our lenders are very, very small, and they have really, really good rates. And everyone is like low rate. And here's the thing, though, we work with big banks. Our big banks, they're big banks. They have more tools, more options, more, they can grow with you. If you're like a budding entrepreneur or an investor or this or that, it might not be the lowest rate, but in 2 years from now, when you want to incorporate and add on a line of credit and refinance and do this and do that, just by their nature, the banks are going to be much bigger. Whereas even a credit union, which is, I define a credit union as kind of a nicer, friendlier bank that's provincially regulated. If you move from Ontario to BC, that credit union will not be in BC, and then your mortgage is not portable. So there's a lot of, understanding where, again, a company like Honda that has a Civic and an Accord, and even it goes to Acura and a high-end Acura, has much more options than one small car company that might only sell, we sell this car and that's it.
Well, that's fabulous information right there. Anybody listening, I think, would already see the advantages of using a mortgage broker, and even for the mortgage broker to, you might be sending them back to the same bank that they would have 100%. Gone to on their own, or give them an option for you, just for that very reason. Because you might be, it's not always about price. We talk about that here all the time. We talked about it last week about commissions and about legal fees. And it's not about price. It's about service, understanding the clients, getting things, being prepared when things go wrong. Who do you want in your corner? Who's part of your team? Things like that. There's all those things come in. It's not just what's the lowest rate out there. And I think that point is great. If you're an entrepreneur and you have potential business in the future, it might be more important for you to establish your relationship with the bank than to do a loan with a smaller lender.
Yeah. And it's funny, but I actually, when I talk to the bank, Mortgage Outlet does hundreds of millions of dollars of volume with each of these banks. Whereas when you walk in, you're like, hey, I'm Joe, I need a mortgage. So, in terms of faster service, better exceptions, better rates, all of those things. And also, again, a more upfront, one of the things that I also talk about is when you sometimes go into your bank, that person might be selling RSPs and savings accounts and TFSAs and mortgages and mutual funds. Mortgages are incredibly complicated, right? I kind of led with that. Whereas all we do is mortgages. So we know all the ins and outs of all of these products.
Elan, how important are, the other aspects that nobody talks about, like prepayment privileges and top-up privileges and all those other factors that we never talk about, but I mean, they're still so fundamentally important when you're looking and you're making a mortgage decision.
Yeah, I mean, that's a great question. And, there's an expression in the mortgage broker industry, which is, do you want the lowest rate or do you want the lowest cost? And again, let's say you get the lowest rate, but that lender's really small and can't grow with you. And then you need to break the mortgage in a couple of years. And then there's a penalty. And then there's, legal fees, which I guess is good for David. And things like that. Well, that's the lowest rate. You got the lowest rate. But if you would have gone for the lowest cost, which might be the rate is a little bit higher, but it's more flexible. There's more options. There's more portability, bridge financing, all of these wonderful things. You're not going to get trapped in that situation. And again, I had a client this morning and I had this discussion and he's like, I want the lowest rate. I want the lowest rate. I want the lowest rate. As a matter of fact, here's a funny story. Sometimes the lowest rate mortgages have the worst fine print. right? And the reason they give you the low rate is they have really, really bad fine print. So when we do our mortgages, the client has to sign the conditional commitment letter from the lender. And then we have an Ontario borrower's disclosure, and then like many other things that you need to sign. And the client decided to break their mortgage, and there was a horrible penalty. And the reason there was a horrible penalty is because they wanted the lowest rate. But the catch was it came with and he called me to complain. He's like, Elan, I didn't know about this. Like, now I'm paying this big penalty. And literally while he was on the phone, I put him on speaker. I went into my email and I found all the documents that he signed, and he signed in 4 separate spots that there's a massive penalty. And I forwarded it to him, and I'm like, I remember talking about it, but like, who cares what we remember? It's like, here you go. You literally initialed about the penalty in 4 separate spots. Like, we had this discussion. So again, is it the lowest rate or the lowest cost? And I understand consumers are like low rate. I get it. But, and again, here's an example. Would you rather, a lot of people pay $120 for their credit card for their annual fee, but they get way more air miles and travel protection. And so like they're paying a little bit more, but they're getting double the miles and car insurance and purchase protection, right? So do you want the best value, or are you just like, give me a low rate?
You know what the difference is between low rates and low cost? Is education.
Yes, right? No, that's 100%.
Yeah, and I mean, that's one of the reasons why we're having this conversation is we want to educate the listeners, the agents, the clients, is what is the difference between low cost and low rates? And there's a huge fundamental difference. Like, banks are here to make money, right? They're
100%.
And they're one of the oldest business and oldest institutions around. And they know that if people move around and try to make, try to save on some of the gaps in different rates, they're going to lose. So how do you attract a client? Well, you offer low rates, right? Something that everybody's really well educated and in tune to, but then you lock them into a contract.
That's right. Exactly.
Yeah. And a lot of times people really do not understand what the prepayment penalties are. And that it's generally, it's not just, a calculation of 3 months interest. It's always 3 months interest, and there's an interest rate differential calculation that most times, clients have no idea that ever existed. They not brought to their attention when they're in the bank, or they didn't understand it. Or they thought, I'm never going to use it anyways. I'm going to have my mortgage. Yeah, it's a 5-year mortgage, but I'm going to be paying a mortgage for 25 years. So I'm never going to be prepaying. But the reality is that sometimes they do want to prepay, and then they're stuck with these really large penalties.
And realtors, I have to stress this. If you're dealing with a client that has a fixed mortgage, before you put the house on the market, you make sure and you find out what that mortgage penalty is. Because let me tell you, if you're selling a $2 million house and the mortgage penalty is $40,000, $50,000, $60,000, and Elan, correct me if I'm wrong, but you've seen penalties like this in the mortgage world.
I've seen 100,000.
$100,000 in the mortgage penalty. If you sell that house and you commit that seller to going through with the sale of that property, and they have to pay $100,000 in an interest penalty, I'd be pretty upset.
Well, maybe we take a minute for Elan to just explain what an interest rate differential is, because it's pretty straightforward if it's just 3 months interest. Anybody can calculate that, but why the interest rate differential can be so expensive.
Yeah, so this is a great topic, and I started off earlier by saying I generally lean towards variable rate. So I'll kind of highlight it this way. Nobody wakes up in the morning and thinks that they're going to get into a car accident, but statistically we know that people are going to get into car accidents. It's inevitable. And similarly with the mortgage, you get divorced, you get married, there's an inheritance, someone passes, you get a job in Costa Rica or whatever, and you need to break your mortgage, right? So generally I'm going to say there's 3 types of penalties. Generally with a variable rate mortgage, it's a 3-month entry penalty, which, it's generally a couple $1,000, but when you're talking about Toronto real estate, hundreds of thousands, millions of dollars of play, like a couple $1,000, like it is what it is, no problem. So that's a variable rate. That's the first category. And there's lots of like little details, but that's kind of a simplification. The second category is called the interest rate differential, which is the IRD. Now, the way I explain it is I actually don't get into the technical side, but I explain the concept of it. So the IRD is a very opaque and volatile calculation used by the banks that when you break a fixed rate mortgage, they're trying to basically make all of that profit that they would have made for the rest of those 5 years or whatever it is. So let me sort of talk about a couple of words that I said. Volatility. Now, and David gave really good advice, and I want to build on that advice. If you're selling your property, if you're playing around with your mortgage, you need to find out what the penalty is. But here's the problem. I've seen, and we know this, if you ask for the penalty, let's say on today's December 8th, let's say the penalty on December 16th, and you ask for the penalty on December 16th, and they're like, it's, $14,000. And you say, you know what, that's a lot of money, but like, I have to do it and it makes sense, $14,000, cool. But then you decide to change the dates by 3 days. That $14,000 can all of a sudden become $42,000 over 3 days. It's not linear. It's not like Friday is this and Monday is that minus a couple bucks. It's completely volatile. And, I know this stuff extremely well. And even there, like, I'm going to digress and tell you a story. A couple of months ago, I literally spoke with a client. They gave me their mortgage information. And I said, you are going to walk into your branch right now. You're going to leave your work right now. You're not picking up your kids, and you are going to go and make these changes today before 5 p.m. That's how volatile the calculations were. So even again, David, you gave really good advice, which is check your penalty, but it is incredibly volatile that the penalty today could be massively different than the penalty the next day. Like, it's literally that simple. It's a very volatile, unpredictable, punitive, harsh calculation. So the best way is to get in front of it, speak with a mortgage professional that fundamentally understands all of the ins and outs and can best predict how to minimize and avoid it. And let me tell you another example. Sometimes I have a client, let's say they have a $700,000 mortgage at RBC, they're a year into it, and they're getting a new property for, $1 million. I'll say to them flat out, guess what? RBC has you as a prisoner. I'm happy to give you a second opinion, but I'm going to tell you right now, stay with RBC, because they're going to charge you $60,000 of penalty. I'm going to save you $45,000, but it's not worth it. And I don't want to waste my time or waste their time, or frankly, go through with it. And then, a week after closing, and there's so much money flying around, people get confused. It'll be like, wait a minute, I paid a $60,000 penalty. I didn't even know this. And then they're going to come to me and say, why did you let me do it? So like, again, in that example, you're like 1 year into a 5-year fixed term. Most likely, I'm going to say, like, stick with your bank, ask them for another couple $100,000, and like, let's talk in, 3-4 years. But again, long story short, so there's the 3-month variable rate, there's the IRD, and then there's the third category, which I kind of spoke about earlier, which is like the really bad fine print mortgage. And the way I describe that is, I'm going to give you the lowest rates, but I might punch you in the stomach 3 years from now. And no one thinks they're going to get punched in the stomach, but like, literally, this is the product that you're getting. And as long as you're okay with it, like, you're okay with it.
Well, yeah, like, banks and lenders are like any other business. No one's giving anything away. So if you're getting an advantage somewhere, there's something else that you may not have. Like, you're talking about stick with RBC, because you're talking about you have a right in the mortgage. You have that the mortgage is portable.
Yes.
And people assume that every single mortgage is portable, but that's
Correct.
not the case,
No.
right? So when you're looking at the really cheap best rate that they forced you to get for them, it turns out that mortgage may not have had portability provisions in it, because
right.
if you're going to get those bells and whistles as part of your mortgage, you're generally paying for that somewhere. You're paying it in fees, or you're paying it with a slightly higher interest rate to have those type of privileges, right? And everybody wants everything for nothing, but nothing comes for nothing. Not in your business, not in David's business, not in my business, right? And certainly not from a lender's point of view. There's a cost to everything. So it's understanding these costs and making informed decisions, you know, where your role gets really important.
Yeah, and again, even portability, like even that in itself becomes a technical word, because most of the lenders we deal with offer portable mortgages, but it's portable subject to requalification. So if you're at a credit union, right, you're not requalifying if you're moving to BC. If you are, some lenders don't offer bridge financing. So if you're not buying and selling on the same day, they're going to say, well, it's portable, but it's only portable on the same day, and we don't offer bridge financing. And now you're triggering penalties and all these costs. So like even the word portable is not, like, it's not as just sort of open as you would think it would be. I had a client that, you know, got a mortgage for, you know, 600,000 and basically kind of semi-retired. He downsized and he needed a mortgage of only 300,000. And the lender didn't want to port his mortgage to a lower amount because his income wasn't there. And I had to like massively escalate it. But it's like, guys, he owes you 600,000. He sold his property. He only wants 300,000. He's giving you 300,000 back, and you're telling him no. But this is how, I mean, again, David, I'm looking at you, David Korman. It's like, this is the fine print, right? This is your butter.
Right. And then it goes the other way too. The example you gave, you know, you have a $700,000 mortgage, you're buying a bigger property, and now you need 800,000 or something. So yeah, you might be able to port that 700,000, but you're also approaching the bank, I need another $100,000. And they're not giving it to you at the same rate that they gave you the 700,000.
Yes.
Right. So you got to do that calculation, and what kind of fees are involved with that. And how, you know, how much is that other 100,000 or 200,000 you need going to cost you? And then, you know, are they blending it together and you're making one payment, or are they keeping it as two separate loans, your original 700 plus the new 100 or 200 at a different rate? And then what type of privileges are attached to that? And do they match up with the privileges that you had 2 years ago when you got your first mortgage at 700,000? There's a lot of factors that go in here.
Actually, I'm going to say one thing that, you know, it's kind of spun as a client benefit, customer benefit, and it is a benefit. But again, it's about understanding what you're getting. Let's say you have a 5-year mortgage with a big bank, and let's say it's like a $700,000 mortgage. And then 2 years in, you know, your career is going well, you decide you want a more expensive house, you go back to that bank. So you've got a mortgage with 3 years left on it, and now you're adding another 500,000 with another 5 years. Well, the banks love when you have offsetting expiry dates, because then they have you as a prisoner. Because you have 700,000 this year, and then 500,000 2 years, and like you've got this IRD thing. So again, as long as you're making an informed decision, you know what you're getting into. But if you're like, oh yeah, I've got 3 years to go here and 5 years to go, on the surface, it sounds great. Until, you know, 3 years from now, and you're like, wait a minute, I only want to renew segment 1, but not segment 2. But now you're not offering me good rates because you know I can't go somewhere else. I'm your prisoner because I'm open on segment 1, but I'm trapped on segment 2. And again, what I tell, like the banks, there's a reason they make billions of dollars every month. They're not going to be like, oh, you know what, we're just going to give you our lowest rates. They know that they have you because you've got 3 years left on the second segment.
Yep. Right. And this is where, you know, again, the low interest rates versus cost come into play, because if you have the right mortgage broker, he's going to explain to you, hey, listen, this mortgage expires in 1 year. We're going to renew at an open rate. Wait until the other mortgage expires.
Exactly.
And we're in a much better negotiating position with the lender.
100%. 100%.
Yeah.
Again, going back to the BMW analogy, your banker doesn't really have an incentive to help you with that.
They want you to keep getting the brand
They
new.
want you to,
vehicle.
2 years in,
No
3 years in,
Mercedes
2
down
years,
the
you're on a
road.
hamster wheel.
Yeah.
Let's just circle back for a second, because you mentioned a couple times you seem to have a preference to variable rate mortgage versus fixed rate mortgage.
Sure.
So let's finish that topic, because I want to make sure we get an understanding of why you lean that way.
Okay. Well, so, it's funny, and we'll talk about these 3 things, but I have 3 pillars that I coach all of my mortgage agents and brokers on. The first pillar is called application and documents, and we'll talk about that. But basically, that means that we're not working on a file until we have all of the client's application and documents. And that goes to my point about, like, we need to flawlessly understand our client. We can't guess. So application and documents. The second answer is it depends, which applies to this answer here. And the third answer is just do it, which is don't sit on your butt all day. Like, just do it and go out and, like, do your thing, right? So the answer here is the second pillar. It depends. I'm never going to be a, like, always do this, always do this, always do this. It depends. Now, let me put it in context. I strongly lean towards variable. But during the pandemic, I had fixed rates at 1.49% for 5 years, fixed, and variable rates at the exact same time for 1.49% variable. In that context, I probably would have said, like, you know what, David, 1.49% for the next 5 years fixed at a big bank. Like, sure, there's this IRD thing, but, like, come on, like 1.49, like it's worth it, right? So The first thing I look at is, what is the spread between fixed and variable? So at that point in time, there was a 0% spread, and rates were like all-time lows. So at that point in time, I would have leaned towards fixed. But let's talk about today. So today, I have variable rates, depending on the kind of mortgage. And again, it depends, but anywhere from like 1%, 1.2%, 1.3% variable. And rates are probably more around 2.49, 2.69, and that sort of range. So, the first thing is the spread. And right now, the spread is around 1.3%. So, and again, I know we'll talk about like inflation and forecast. I think rates are going to rise in the next 6, 12, 18, 24, 36 months. But if you have a rate of 1.2 today, and it goes to 1.5 and 1.7 and 2 and 2.2 and 2.5 and even 2.8, you have saved so much money in the first year and the second year and the third year. Plus, you don't have this IRD penalty thing hanging over. And again, one of the things that I advise my clients, and this is kind of a kind of cool way of mitigating, but if you would have taken that fixed rate at 2.49, let's say your payment was $2,500, but the variable rate payment was $2,000 because your rate is 1.2, I'd say take the $2,000 and then pretend like you have the $2,500 fixed payment and basically pay $500 more every month, and that's going directly into your principal. Now, you're really crushing your amortization. Number one, because you're putting in that extra $500. But number two, when you look at an amortization, and again, we can get really nerdy here, but on a $2,000 payment, on a 1.2% variable rate, about $1,000 of that is interest and $1,000 is principal. So you're only paying $1,000 a month in interest. Whereas on the $2,500 fixed payment, which is a fixed rate, you're basically at about a 60, 40, 65, 35, meaning about $1,400 is interest, and then a lesser portion is principal. So again, I'm kind of like, go variable, increase your payment. You've got no IRD, all of these wonderful things. Now, one of the biggest misconceptions that all consumers have, and this is huge, is that they are worried that if variable rates increase, they're not going to be able to make their mortgage payments every month, which is a very logical concern and worry. But we have lenders that will keep your mortgage payment the same. So let's say you're 1.2 variable, $2,000 a month, and let's say 1,000 a month of that 2,000 is interest and 1,000 is principal. And let's say in 6 months rates increase. Well, all that will happen is your payment stays the exact same at 2,000, but now all of a sudden 900 is principal and 1,100 is interest. So in the background, the bank is changing the amortization allocation. So as a consumer, it's like, oh my God, my payment is going to go up. My payment is going to go up. But that actually doesn't usually happen, again, depending on the lender. So this is part of the discussion about, well, Bank A has a lower rate, but Bank B has more of a stable variable payment. And again, this is part of the discussion.
Yeah, that's an excellent point.
Yeah, mortgages can be so technical, right? And
they're incredibly technical.
It makes such a big difference. And I mean, the first example that you gave, making the fixed rate payment on a variable mortgage, I mean, that could probably save about 3.5 years over a 25-year period off of somebody's mortgage.
Maybe more.
Maybe more.
Yeah.
In theory, it sounds beautiful. Do people actually do it? Like, it's a
Yes,
hard thing
yes,
to have
yes.
that kind of discipline.
Good. No, good. Well, so here's an interesting thing. So I would say right now, over 80% of my clients are going variable. And I want to preference this. I use all kinds of personal examples and analogies. I drive a Volvo and my wife drives a Volvo. So I don't want you guys to think that I'm like crazy risk, like everyone go crazy and whatever. Like I am a risk conscious person. And people think, and here's the misconception, fixed rates are safer than variable rates. They're not safer. The risk is different. The risk with fixed rates is IRD, right? The risk with variable is rising rates. Now, here's you used the word, I think you used the word discipline, David. Here's the crazy environment that we're in. I tell my clients this whole thing and they're like, I'm going to take the $2,000 variable payment and I'm going to pretend like I have the fixed payment at $2,500 and I'm going to crush my amortization. And even if rates rise, okay, so here is the icing on the cake, on the gravy, on the cherry, on the everything. Here's the crazy thing. Interest rates are so low right now. Why would you rush to pay it off? Inflation is 3, 4, 5, 6, 7%, depending on how you want to figure it. Why would you pay off a debt that's 1.2%? So okay, I'm aligned, I'm going to increase it, but it's but why would you do that? Why would you increase your payment when you could invest or pay down debt or, whatever it is, right? So
more real estate.
What?
Buy more real estate.
Exactly. No, exactly. Right. So it's I actually, again, my role is to provide options, but in theory, that's a mitigation strategy of rising rates. But again, the environment is, why would you rush to pay off debt that in a real sense, when I say real, like real inflation, real rates, it's a negative rate. It's inflation is 3, 4, 5%. You're paying 1.2. You're getting negative money. You're getting paid for the money. So everyone has their own personal circumstances.
Well, that's a great point. So in theory, if you were in that situation, you're going to pretend that you've got this extra $500 that you'd be paying down. You're saying in theory, instead of paying down the more, do something else with that $500, invest it in something, or, if you can have that type of discipline, you're actually better off if you could invest in something that's going to earn more money than what you're saving by paying down such a low interest rate.
Well, again, let's say you're not contributing to your RSPs. Let's say you're not contributing to your TFSAs. If you take that $500 and put it in every month, that's $6,000 that you've now contributed. You've now built up a retirement, and you're going to get a $3,000 refund when you file your taxes. So again, why would you dump that money in if you have other places to use it?
Right. That's a great point. So while we're on this point, maybe we should just talk a little bit about the inflation that's going on right now, because that's big in the news and everybody's aware of it. We're all of a sudden we're in more inflationary times than we've been in recent years, and interest rates, and there's always discussion. Interest rates are going to go up. We can only discuss it that way because we can't really discuss interest rates going down when they're at never. And if we had this conversation a year ago, we'd all say, oh, interest rates are going to go up because they're probably going to go up. But if they do go up, like how fast are they going to go up? Like how long, like, is this going to be a creeping process? Are interest rates going to double all of a sudden? Like people are nervous about that. Oh, if the interest rate's I'm paying 1.5. What if it doubles? Well, if it doubles, you're paying 3%. That's not 20%.
No.
Like we're not going back to those days. Like my first mortgage was over 21% for the first house that I got. Like,
well, it's funny because it's funny. Before I got into the industry and I talk about driving 2 Volvos and being risk averse, I actually got a 10-year fixed rate mortgage at 4.65%. And I remember signing the papers and I was like, I'm the smartest person of all time. Like literally, I'm like, this is like no one in the history of time has anyone done anything. So now the funny thing is, and I'm not going to get into this too much, the 10-year mortgage product is the worst mortgage product ever. So don't get it. And I didn't do that. That was before. So like, it's again, just like I'm so smart. Anyway, so, I do think rates are going to rise. And again, looking at the different banks, first thing I tell my clients is that your crystal ball is as good as mine. But if I look to the banks, frankly speaking, Scotia is predicting 8 rate hikes within the next 2 years, which is like 2%. So if you're at 1.2, theoretically, your rate could go up to 3.2. Now, I don't necessarily think, and again, a lot of the other banks are not necessarily that high. I think that there's going to be, I actually would like to see one rate hike in like March, and just like a little tap, because a lot of borrowers are, we have short memories and they just think that this is going to go on forever. And you just want to give them just a little reminder that rates are not going to be this low forever. And then just take a nice little pause, right? That would be kind of what I would do, like a nice little tap in March, maybe 6 months later, another little tap, just to remind people, right? Now, I think it was yesterday, but there was a huge jobs report, massive new employment, Canadian economy on fire, everything is great. So, the reality is that just even based on the news from, I think it was yesterday, there's more likelihood of inflation. The Federal Reserve in the US and also in Canada, the Bank of Canada, they were using the word transitory inflation, it's just kind of temporary, circumstantial. Now they're saying it's real inflation. So I don't really know anyone that's not saying that rates are going to go up. I think that everyone is kind of saying rates are definitely going up. The question is, how fast are they going to go up, and how high are they going to go up? Because if they go up every 4-6 months and you kind of employ my strategy, I still think you're better off. If they're going to go up every 3 months, for the next 2-3 years, well, that's going to be less ideal. But rates are going to go up for sure. I would predict 3 rate hikes next year. And then the challenges is as well, there's new COVID strains. There's, I'm even hearing rumors of new lockdowns and stuff. So, that could damper, some of these concerns. And that's, we talked about this earlier in the podcast that, the volatility, the visibility, everything is week to week. A lot of companies, recently announced that they're delaying return to the office dates. They were going to come January 6th, January 16th, whatever it was. Now they're looking at spring. So everything is really changing. But in short, I think there'll be at least, 3, I would predict 3 rate hikes next year. I'd say spring, maybe summer, and then kind of late 2022. That would be my prediction.
So you'll correct me if I'm wrong, because I'm no economist, but I know it makes sense for there to be some rate hikes. There's actually good things, for the overall economy if the rates go up a little bit. On the other hand, there's always been political pressures to keep the rates down, or if they are going to increase, at least make sure it's gradual and in small increments so nobody gets hammered quickly, because they don't want to shut the economy down. They don't want to kill it. They don't want to kill our industry. They don't want to kill the real estate industry. The real estate industry drives most of the economy.
Yes.
Because it leads to so many other things, to manufacturing and to, for housing and furniture and, and on and on. There's so many things. So they don't want to kill it, right? But sometimes they want to, put some reality to it and slow it down a little bit, or get back to realistic numbers. But I don't think people out there should be panicked thinking, oh, in March, if the rates, like Elan said, the rates might go up in March. And if the rates go up, it might go up from 1.29 and all of a sudden it's going to be 7 or something like that. It's not going to happen like that, right? There's too much political pressure to keep anything that's going to change to be slow, gradual, and more marginal, right?
And again, the words, I like the expression, like and this is what, like, tap the brakes. Just give people a little reminder, like,
right,
cannot stay at this low forever. We're just reminding you that. And then let it, like, kind of sink in and kind of wait and pause. And you're right, David. And again, I tell this to clients as well, that, when people are, they have anxiety about variable rates, and I get it. It's a fair concern. The reality is, if rates started going up too quickly, Canadians would freak out, right? It's just, I actually use the analogy that it's a bit like a drug. And we're addicted to this drug of low rates. And if all of a sudden it's like withdrawal, we're going to go from 1.2 to 4.9, like, we're going to have withdrawal. So it needs to be slow and deliberate and methodical. And again, when rates start rising, there are winners and losers. Some industries are like, raise rates. And other industries are like, no, keep them low. So it does need to be tap the brakes, very deliberate, very kind of slow and methodical, and announce your intentions.
And I look at it like there's two different categories of freak out that we do. One is those that already have a mortgage.
Yes.
Are starting to go up on them and they're not sure to afford their own mortgage. The other ones that really freak out is, oh my God, my mortgage is up in the spring. I got to renew my mortgage. I had a mortgage at this low rate for 5 years, whether it was fixed or variable. I've had the advantage of the last 3 years, 5 years. And all of a sudden I got to renew in the spring. And then what? Am I going to be able to afford the house I currently live in?
Yeah.
So they're really freaking.
It's funny because there's actually two dynamics here. So the prime rate of Canada is 2.45%. Now, generally the way that variable rates are set is, as of today, a lot of my lenders are, I'll just keep the math simple, but let's say lenders are at prime -1. So, 2.45 minus 1%, our rate is 1.45, simple math. What I actually think is going to happen is, I think that the margin, that the profit that the bank wants to take, they're going to want to increase their margins. So instead of offering, prime -1, I actually think they might start tightening and go to prime -0.75. So even if the prime rate stays the exact same, the interest rate that as a consumer will pay is actually 25 basis points higher. And again, it's not in the news, it's not this, it's that. It's just like, yeah, we need to tighten our margins, this, that, and the other. We're not offering prime -1. It's discontinued. Now we're at prime -0.75. And that's completely separated from the Bank of Canada and the prime rate and all those wonderful things.
Yeah, Elan, all banks would have to make that decision, because if one bank made that decision and the other three banks decided not to make that decision, that bank would lose huge market share very quickly. And we saw this last year with CMHC and the policy that they tried to implement, and then the other insurer didn't follow, and all of a sudden CMHC lost huge market share.
I know we're running out of time, but I do want to bring up one thing that's very important to all home buyers. Again, I talked about my 3 pillars. I promised to go back to the first one, application and documents. And, as a mortgage professional, my pet peeve is online mortgage calculators, or, you go online, you enter a form and it's like, hey, I'm pre-approved for 700,000. Like, avoid. If there's one piece of advice that I would give people, if you're dealing with a mortgage professional that is not asking you for all of your documents up front, find another mortgage professional, because the reality is, and again, I have a nice analogy for you, but if you went to a doctor and you said to your doctor, I want, quadruple bypass surgery, and that doctor didn't say, okay, I want an MRI and a CAT scan and an EKG and blood pressure and this and that, you'd say the doctor's crazy. And mortgages are so technical. Are you divorced? Does the house have a basement apartment? Do you have student loans? Are you incorporated? Like all of let me give you a very, very specific example. A lot of lenders will include child tax credit as part of your income, okay? Now, if you take a 5-year mortgage and your child is 12, they're gonna be 17 and there's no problem. So literally sometimes I will say, how old are your kids? And if they say, well, my oldest is 12, I'll say, great, when is their birthday? And the reason why I'm asking when their birthday is because if their birthday is tomorrow and they turn 13 and they buy a house a month from now, all of a sudden that $400 of child tax credit I cannot use. So if I'm not asking you literally how old your kids are, that is a big concern. And again, another analogy that I use is getting a mortgage is like going through airport security. You're going to take off your shoes. You're going to take off your belt. They're going to throw out your bottle of water. They're going to swab your laptop. And at the end of the day, if you want to get on that plane, the best thing to do is just like, here you go. I get it. We're all doing the same job, and then do it. Like if you're going to argue, and I actually won't put up with clients arguing with me. At the end of the day, I know the process. I'm not going to get into it, but like either you're giving me your docs or you're going to find someone else, because I'm not going to give you advice. I'm not going to open you up for surgery. And while we're in the middle of surgery, find out that you actually had some type of other thing that now I can't do the surgery. So again, very simple. The one piece of advice I would give, if you're dealing with a mortgage professional that is not asking for every document, oh, we're getting a gift. I just had this the other week. The gift is coming from Bangladesh and it's coming through a third-party remittance. Like there's anti-money laundering, there's FinTrack, and again, part of the role as a mortgage broker is to understand what rules I can break, what rules I can bend, and what rules are unbreakable. And if you've got a large deposit coming in right before closing at a sanctioned country, this is not like a Elan thing or a bank thing. This is like, it's not getting done. So this is why we're like all docs, 3 pillars, application and documents. 1. Number 2, once we flawlessly understand the client, it depends. Well, if you want a minivan, you're going to be able to do carpool. If you want a cool car, we have a Ferrari. You make the decision, but now you're making an informed decision. So that's something that it's really important to me, critical. And even going back, like if you've got a mortgage right now with RBC, the first document I want to see is your RBC statement, because our conversation might be like, cool, you're an RBC prisoner, go to them, get their information, and then come back to me and I'll give you a second opinion for free. Let's stay in touch, but you're staying with RBC. So application and documents, it depends. And then I'm going to end it off. I guess we're not going to have time for this, but pre-approvals and firm offers. This is a massive, massive thing. And, again, if you're making a firm offer, if your mortgage professional, again, did not ask for every single document, unless you have a lot of wealth, if you have wealthy parents or whatever it is, you're taking a risk. If you've got less than 20% down. But the key thing is you really need to understand the context. And again, David Korman, a good question for you. You're making a legally binding offer. It's not Costco that you could go back in 5 months and change your mind. That's it. The house didn't appraise. It's got mold. The foundation is leaking. Your identity was stolen 2 weeks ago and we never talked about it. Firm offers. So I know that's kind of like a big bomb to let off just as we end, but
we're not ending yet. We still got a couple minutes, but that's the exact topic that I wanted to get into here, because David and I have talked about this on previous podcasts. when we were talking about, pre-construction, people entering to that, and they need to show that they've got their mortgage approval. And sometimes on resale too, people are like, oh, I got my mortgage approval. And then it comes to me at some point, I'm going like, this isn't worth the paper it's written on. You're approved for a mortgage as long as you comply with the following 20 conditions, because they haven't submitted anything. They haven't given them their bank statement yet. They haven't shown them what they've got in their account. They haven't shown the bank a statement from their employer. They haven't showed them their tax returns for the last couple of years. They haven't done any of that. But they got a letter from the bank saying, oh, I'm pre-approved for a mortgage up to X dollars, right? And you've got this laundry list of conditions that they may never satisfy with the lender.
Well, I call it, and again, I coach my team. I have very, very specific language, and I would lobby in the industry to change it. But the industry language is called a commitment letter. And I think that it should be called a conditional commitment letter, because it's a commitment subject to 15 things. And if satisfy all those 15 things, like, guess what? Like, not happening.
Right.
A mortgage is a demand loan at the end of the day, right? And at any point in time, the bank can come back if there's a substantial change to the disclosed position.
Right.
We call that mortgage at any point in time.
Right. And again, I'll tell you guys something funny. I know you like the car thing. I tell my clients, after you get the keys from David Korman, after you get the keys from Jonathan Cohen, you can go and lease 4 Porsches. I don't care. But until you get those keys, like, don't quit your job. Don't co-sign. You know what the worst is? And again, knock on wood, this has never happened. Don't go to Leon's and buy furniture. Don't pay for a year.
Right.
It's like, that's still a liability. Like, you're changing your liability. And I know as a consumer, oh, I don't have to pay. But it's on your credit bureau. It's a liability, right? So, once you get your keys, by all means, do what you got to do. But until you get your keys, keep it nice and clean.
It's great advice.
Another issue maybe we can talk on for a minute, because you mentioned it before, is these gift letters.
Yes.
Right? And lenders, there's a lot of people right now that are getting help, especially first-time buyers getting help from parents to buy it. And either they're getting help because they need the parents actually on the mortgage, as in the old days, they were strictly guarantors. Now the lenders all insist they actually go on title for a percentage interest. But the lenders are always asking too, what's the source of your down payment?
Yeah.
Is it your own money? Where is it coming from? Show it, not just tell me about it, prove it. Show me, show me where it's coming from. Are you getting a gift? And if you are getting a gift, doesn't mean you don't qualify, but the lender wants to know about it, right? And sometimes you won't qualify if you're getting it, right? So maybe you could just comment on that.
Well, again, it boils down to the first pillar, which is application and documents. And the second pillar, it depends. If you're buying, your own property, you're going to move into it, it's sort of the classic bank of mom and dad, like, cool, gift letter, no problem. But it depends. Is the money coming from a sanctioned country? How long has it been in Canada? Is it from your mom, or is it from your second cousins, brothers, this? And again, I'm like, banks aren't stupid. Like, it can't be your cousins, this and that. And again, is it a rental property? Many lenders don't like gifts on rental properties. Why? Because, and again, I'm going to stereotype, you got this like spoiled brat kid, mommy and daddy are writing him a $200,000 check on $1 million rental purchase. And then the spoiled kid is like, I don't want this, I'm bored. And then they like take off to Costa Rica. Well, what's the bank going to do? So on a rental property, it's very different than a primary residence or owner occupied. So again, gifts, very simple. What's the source? Is it in Canada? How long? Is it mom and dad? Even grandparents. Another one is like, we have modern family. Like, I've had situation where it's like, well, it's my mom's husband, and he raised me for the last 30 years, but he's not legally my guardian and this and that. Like, that's the conversation we're having in stage 1 application documents. We're not having it in, oh, I bought a firm property for 1.3 million closing in 3 weeks. Like, that's not, and sorry, I'm going to say this as well. I tell every one of my clients, before you sign the purchase offer, the offer to purchase, I want to see the MLS listing. I want to re-review everything from top to bottom. Are you still at your job? Is our credit report current? The MLS says land value only, tear it down anytime, like mold everywhere, seller to pay, for remediation. I want to see that before you sign the offer. There's a condo blacklist. Certain condos are known to have really bad. So I want to know that before my biggest nightmare is I'm like, okay, David, you're pre-approved. Everything is great. And then I get a purchase agreement for a property and it's got structural damage and it's on the condo blacklist and this and that. We need to have that conversation.
Well, Elan, you really brought it today. I can tell you that. Hey, David?
I always bring it.
He really brought it. You got your A game going today. Mind you, I've seen you in action before. This is you, Elan. So for those in our audience, that hasn't been exposed to you, I think they're in for a treat. I'm sure everybody will enjoy this. And
can you tell that I like mortgages, by the way?
It's great to have you on because you have such a passion for this and a deep understanding of your own role in the industry. And what my role is, and what David's role is. You understand and have a respect for everybody else. And that's what we talk about on these podcasts a lot. And I think this was fabulous.
Okay, I have to end with another analogy though. I tell my clients, listen to this. I tell my clients, I'm the cardiologist, I'm the heart surgeon. David is the neurologist, he's the brain surgeon, and David is the orthopedic surgeon. I am not going to give brain surgery advice. I am not going to give orthopedic advice. I'm going to stay in my lane. Right. And that's, again, a very, very important tip for a realtor, especially because things that might seem trivial are actually, again, you see these downstream impacts. Literally, the child turned 13 and all of a sudden the mortgage doesn't work anymore. So stay in your lane, right? I'm the mortgage broker. David is the realtor. David is the lawyer. Frequent communication. And that's the best we can do to do our due diligence and make sure everything works smoothly.
Well, my mother's going to be so excited if I get her to listen to that I finally became the doctor that she wanted.
Oh, yes. Yes.
Same with my parents for that reason.
And my wife for that matter. We had this conversation last night. She said, we need a doctor in the family. I said, well, I'm a doctor of jurisprudence. You want me to check your jurisprudence? I can check you out. Yeah, you're useless to me. So.
Elan, this was great. And I mean, your passion shines through what you say and your advice. And I think any client would be absolutely lucky to be working with your office to get their mortgage products because it is very complicated. It's not a one size fits all approach. And, getting to know your clients and really giving them proper advice is what David and I are all about. So thank you so much.
Amazing.
For today. It was an absolute pleasure having you on board.
Thank you. It was great. It was a lot of fun.
Thanks, Elan.
Hey, take care.
Stay safe, everybody.
Thanks, David.
Bye.
Welcome to David and David on Real Estate. Join us as we explore the ins and outs of the real estate market and dive deep to understand the issues affecting buyers, sellers, investors, and businesses. If you love real estate as much as we do, sit back, relax, and gain an insider's edge to the exciting world of real estate. David Gorski is a broker and the owner of Sutton Summit Realty, a powerhouse brokerage providing guidance to over 180 realtors. And David Korman is a partner at Kormans LLP, a respected law firm specializing in residential and commercial real estate transactions, with offices located in Toronto, Mississauga, and Markham.